This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
This chapter looks at the typical sort of items that can occur in any question, kind of dealing with risk, whether it's business risk or audit risk. Sometimes it's just dealing with issues. Sometimes it's asking you to plan the audit. What significance do these revelations have in planning of the audit? Sometimes it asks you about the sort of information and evidence you would like to find, given the information which is presented to you. Very often the information is presented as the notes coming from maybe a discussion between the finance director and the partner in charge, and you're to use these as the basis for planning and responding in some way. So remember, we're thinking of kind of what could go wrong. We're kind of thinking of maybe inherent risk. What does this mean for getting figures wrong initially in the financial statements? And when we're talking about misstatements or getting figures wrong, remember it's not just the amount that we're looking at. We're thinking of presentation, we're thinking of disclosure. We're thinking of, what does the accounting standard or the financial reporting standard say should be calculated or displayed in respect of this item. And that often gives you additional evidence that you have to get. So if you are worried simply about inventory not selling very well, and it has to be valued at the lower of cost and net realizable value, the sort of evidence you would presumably be looking for is you have a discussion with the salespeople, maybe discussion with the CEO. You maybe look at the board minutes to see if they're particularly worried about this product that's not selling. You would look at inventory records, maybe to see if it's selling at all. And you would try and look at invoices, if there had been any sales recently, to see whether or not the company had to bring way down the selling price of that inventory, particularly if it had gone down below cost. The best way, I think, to do this is maybe to look through the first bit of the chapter, where we have the items displayed, the details displayed. The answers are provided, but it might be better if instead of reading the answers, you just kind of watch as we kind of talk through what issues are maybe raised. Now the first one here is the example I gave right at the very beginning of the lectures when we were kind of introducing the paper. During an inventory count, a company which makes jam and marmalade, a box containing 12 jars was dropped. The jars were broken. Immediately noticed that there was a bad smell, it should say, not a small, a smell, it should say. And it obviously gone off or be contaminated. So what are the kind of audit implications of this? And first of all, obviously that particular packet of 12 jars is going to have to be written off. But then what we should be thinking of is this an isolated problem? And you would ask maybe to go to some other cartons from the same batch in particular, and choose maybe 3 or 4, half a dozen jars at random, have them opened, smell them, see if they are also contaminated. And then you might go outside the immediate batch. If you've got bad results there, you might go outside the immediate batch and take a few jars from other batches that are around the place. If they seem to be also contaminated, you begin to, I suppose, want to ask production people, how could this have happened? How much production could be affected? You would extend your testing way out to different sorts of products, not just jam and marmalade, but maybe any other sort of preserves that the company made. Then you'd have to start worrying about where these have been sold to, because presumably you would want to get in touch with the, let's say, supermarkets who were stocking these products, and to warn them that they should be returned. There would be journal entries to return these. You'd have to write down the value of the inventory. There'd probably be compensation to think about to these supermarkets for their bother. You may have to return money to them. Then you should worry whether the supermarkets have sold some of these products to their customers, consumers like ourselves, and it's in their cupboards or fridges. You have to get the supermarkets to contact those people or to put adverts in a newspaper, again more expense, which is probably a liability of the manufacturer. You have to get the customers to return those jars. And then, worst of all, what happens if some customers had consumed some of the product and had become ill, or even worse, had been killed by food poisoning, something of that sort. And the whole issue kind of opens up about what is the potential legal liabilities. What's it going to do to our reputation, our goodwill? Is it actually going to be some sort of going concern issue if it turns out that we have harmed an awful lot of people and their trust in the product and the trademark and so on is fatally undermined? So from that small, almost insignificant issue, by thinking, what's the worst could happen, what could happen, the whole thing kind of explodes into a whole range of issues, some of which are very, very serious indeed. Second one. On a review of an audit file, a partner in charge discovered that a junior audit assistant had marked correctly accounted for the purchase of a car where the VAT element had been posted by the client to input VAT. Now, in case you don't remember, input VAT on cars is not recoverable. It should be capitalized along with the cost of the car. So what are the issues here? Well, obviously that car has been incorrectly accounted for. We have to take the VAT out. Out of the input VAT account, and we have to put it back into the Then the second item. On the final review of an audit file, the partner in charge discovered that an audit junior had marked as correctly accounted for the purchase of a car where the VAT element had been posted by the client as input VAT. And in case you don't remember, VAT is not recoverable on cars. It should be capitalized as part of the cost of the car. So what are the implications? Well, the first and obvious one is that car has been incorrectly accounted for, and that VAT return contains an error. So we have to correct that. We have to perhaps admit to the tax authorities that we got our VAT wrong. We've maybe reclaimed too much VAT. There may, of course, be penalties to pay on that. And we have to put that amount back and add it on to the cost of the car. And maybe we have to redo our depreciation calculations at year end because the car is obviously a different cost. And then we should begin to think, what are the implications? Well, if they've done it for one car, what happens if the company had bought 20 cars in the year? Have they all been incorrectly treated? Do we have to go through all of those invoices to see really whether it's an isolated error or whether it's kind of systemic? And of course the incorrect VAT, the incorrect claims from the government are just escalating, and potential penalties are escalating. And maybe we have to set up some sort of provision for the really resulting from the kind of business risk here, compliance risk. We haven't dealt correctly with tax law. But also within this, we should be worried. When the partner is reviewing an audit file, let's say it's a final review, we're almost at the end of the process. So really what should happen in the quality control is that the junior audit assistant did the work, obviously incorrectly. That should have been reviewed by the supervisor, who should have picked it up. That should have been reviewed by a manager, who should have picked it up. And now at the very last moment, the 11th hour, it's a partner who picks it up. And we should be thinking about maybe the quality control procedures which are in place. First of all, giving this work to an audit assistant sufficiently junior not to know the proper treatment of VAT. There's maybe an assignment problem. There's certainly a supervision problem. There's certainly a kind of supervision, direction, review problems going on within that. Then it seems the supervisor didn't do the job right. Maybe the supervisor didn't know. Maybe the supervisor didn't review stuff very well, was very careless in the review. And obviously the manager wasn't great either on this. So we begin to think, and if the manager and the supervisor weren't very good on that audit, what about all the other audits in which they were involved as well? Could they all contain bad work, really, whether or not it's actually to do with a car? And really what we should be thinking of doing is maybe reviewing the whole quality control procedures in the company to see if they're adequate. Non-current asset schedule. Depreciation rates are all straight line. Cars 25%, land and buildings 2%, computers 10%. Cars are 5 years old normally when sold. What kind of issues might this raise? And the first thing we should kind of be thinking of doing is maybe just adding up. I think this one has been set up so that everything does in fact add up correctly within this schedule. That might be the first place for a kind of error to be seen within that. And then we should be thinking maybe about some of the calculations which are going on within this. So, cars are depreciated at 25%, and we look at the car and the cost at the end of the year is 240. The charge is 25% of that, so that kind of seems to be okay. But then we might see a kind of a bit of a mismatch going on here. That cars are depreciated at 25%, but the cars are lasting really 5 years. And if cars are really lasting 5 years, it implies a depreciation rate should be 20%. As the company deliberately set the depreciation at 25% to depress profits, or is it just something they haven't adjusted? Do we need to think about changing the depreciation rate to a better estimate? We look at land and buildings. We see it's at 2%, and indeed the 200 in there is at 2% of 10,000. But the problem here is land and buildings. You should know that land, particularly if it's freehold land, it doesn't actually say, but it's something worth asking. Oh, it does say up here it's freehold land, up here. Freehold land is not depreciated. Yet presumably in this cost of 10,000 here there is a mix of the cost of the land and the cost of the buildings, and only the buildings should be depreciated at a 2%. When we look at our computers, first of all, I think we'll be able to say that maybe 10% seems a very low rate of depreciation. We're implying our computers are lasting 10 years, and I don't think it's many that actually do that, because before they become outdated and you replace them and so on. And we get even more evidence there when we look at the depreciation on the disposals. Here we are disposing of items which cost, sorry I didn't mean to do that, which cost us in there 400, and the depreciation on that is 100. So that kind of implies that these items have been depreciated for only 4 years when they're disposed of. It's a long way from the 10% that we are charging them. So that doesn't look great either. So there's a number of quite subtle errors which I think are hidden within that information, and which an astute auditor would be expected to find. And then I suppose what we'll be thinking of doing is to thinking of working out the value of these misstatements if everything had gone back to a more normal sort of rates. If we depreciated our computers over 4 years, our vehicles over 5 years, we took out the depreciation of freehold land, what effect would that have on the profits and so on? It would be a better question, where we're not kind of doing it here, but it would be a kind of a better question if we could do materiality. So we're right, but if we knew whether or not these amounts are actually material, then we could make a bit of a judgment. Number 4. A television company has built a small village to be used in filming a popular long-running TV program. The village has been built in a land of an area of natural beauty, and permission to build was only granted on the conditions that after 20 years, when the filming had ceased, that the village was dismantled and the land was kind of re-landscaped and put back to where it was originally. What are the problems here? And potentially 2 problems. It's all to do with kind of the construction and the valuation of non-current assets. First is that it is likely to take some time to create a small village. And the accounting standard relating to this says that if you are borrowing money to create a non-current asset, then part of the cost of that asset is the interest payments on those finance costs, and you capitalize between when the construction starts and when the construction is finished. The second element is it's this business of demolishing. We're locked into this agreement, and again, a cost of the non-current asset has to take into account, has to basically add to the cost of the non-current asset these future costs of demolishing or dismantling the non-current asset. And the way these have to be calculated is you say, in 20 years' time, I think it's going to cost, 500,000. But then you have to discount that, because that's a cost happening in 5-10 years' time, whatever the 20 years' time here. You have to discount this back to the present. And then every year you get closer to this, life end of the building here, you have to kind of gradually unwind that discounting, because you're getting closer and closer to the time when you're going to actually have to pay this demolishing, dismantling cost. So there's again hidden quite deeply on this, unless you remembered your accounting standard dealing with the valuation or the establishment of the cost of non-current assets, you would not have picked that up. The audit of a new client is in progress. The holding company imports small decorative items from abroad. The subsidiary trades through 12 takeaway pizza shops, which are very profitable. Dividends are regularly paid by the subsidiary to the holding company. During the audit, an inventory count showed that the holding company had imported some modern items which look to be made of ivory, which is a banned product. Invoices for these items traced through the goods received note described them as being made from a synthetic material. What are the issues here? First of all, first audit of a new client increases business risk. You know relatively little about this client or the people involved. You've had relatively little time to judge their integrity and so on. We should always be, hopefully we've gone through the right type of procedures, to accept the client, that we have done some sort of investigation. I would hope that we've gone through the money laundering procedures, which say know your client. I would hope that we should have talked to the outgoing auditor and asked them about their experiences with the client. And that is certainly relevant or potentially relevant in answering this question. Its subsidiary trades through 12 takeaway pizza shops, which are very profitable. Now, it's good that they're profitable, but pizza shops are cash-based businesses, largely. It says they are very profitable. Is this implying that they are unrealistically profitable? And dividends are regularly paid out of this. So is this a kind of potential placement of funds for money laundering purposes? And we know that we have a holding company, another subsidiary abroad, and of course this could potentially facilitate sending money abroad, and of course they're importing stuff from abroad. So money is going from the holding company abroad, and then goodness knows how many other bank accounts it's going through. So what we should be alert to here is we're not quite at the suspicion level of money laundering yet, but it should be high on our lists of risks to look for. And then we see they're importing these items from abroad, which appear to be made of ivory, a banned substance. The goods received notes say, and presumably the invoices, say that these are made of a synthetic material, but to what extent can we trust that? Should we, for example, get an expert in to test these imports to see if they are plastic or if indeed they are ivory? If they turn out to be ivory, then we have a company which is breaking the law. We have to decide, in discussion with them perhaps, if that breaking the law is innocent or if it is deliberate. And then we have to consider the reporting requirements on this. But there will of course be some accounting implications, because the inventory of ivory, say, you're not allowed to sell it. And if you're not allowed to sell it, then its net realizable value is zero. So it could possibly be adjustments in the financial statements, and there's this whole problem arising about whether or not to notify the authorities that your client seems to be undertaking illegal activities. And certainly legal advice is going to be warranted here. Next. A large printing machine, originally costing 5 million, and its accumulating depreciation amounts to 3 million, so it has a carrying value of 2 million. The sale value of the company to an overseas buyer, net of selling costs, is believed to be 10 million Burundian pounds, and the exchange rate was 4 Burundian pounds to the dollar. So essentially it's going to be coming in for 2.5 million. The value in use, using cash flow projections at a discount rate of 5%, is 1.5 million. So what we have here is essentially a kind of valuation of the non-current asset. We also have a non-current asset which has been set aside for sale. We have to see, have contracts been signed? Is it definitely set aside for sale? We're going to look at the board minutes and so on. We shouldn't be depreciating it. If it's set aside for sale, its value in the financial statement should be the lower of the current carrying value, 2 million, or the 2.5, if indeed it turns out to be 2.5, because there are exchange rate fluctuations possibly going on, and the exchange rate wouldn't have to weaken too much before your 10 million Burundian pounds were worth less than 2.5 million. And if it did become less than 2.5 million, you should be writing down the book value to that lower figure. So, again, quite a lot of difficulties. Again, you need to know the accounting standard, particularly on assets which have been marked for sale, non-current assets marked for sale, how they have to be kind of isolated out and the proper treatment of that. You are the auditor of a group of companies. One of the subsidiaries has a poor cash flow, and it seems that the bank is unlikely to renew its borrowing facility. finance director of the holding company has told you that it will make the required loan to the subsidiary to keep it solvent. So we're kind of saying that this subsidiary is doomed unless it gets the loan from the holding company. When we get on to looking at the audit of groups, you'll see that this letter is sometimes called a letter of support or a comfort letter. The issue really is these letters are very easy to give. Anyone can write a letter saying, I'll support you. What we need to investigate here is whether the support is actually likely. So can the holding company afford to support the subsidiary? Have they agreed within the board to extend this support? So if you're looking at the board minutes, maybe if you looked at the financial projections, the budgets and so on of subsidiary, what are they saying? Are they showing an amount coming in, an amount that's expected to be coming from the holding company? Does it kind of make sense? Is everything in place, or do we think they're just going to issue this kind of letter in the hope it'll get through this year's audit without you having to really draw up the subsidiary's financial statements on a breakup basis? It's also something that you would expect to come into a letter of representation, that this support is going to be extended to the subsidiary. Finally, in this group, a company has changed the way in which it values inventory from FIFO to the average stock basis, and has also changed its rate of depreciation on machinery from 20 to 15%. First of all, is it allowed to? Is it permissible to change inventory from FIFO to average stock? Are they permissible under the accounting standard? Are they permissible ways of valuing inventory? And yes, they are. If it had valued at LIFO, then we're in problems. Secondly, are they allowed to revalue? Are they actually allowed to change their accounting policy? And yes, they are. But there are rules and regulations stipulating really that you're only allowed to make the change if you think the new policy is better. You have to evaluate the amount of the change and so on. And the other element here is if you're changing an accounting policy, it is what's known as a retrospective change. In other words, you have to deal with it essentially as though it had always been the accounting policy, which means that your opening stock figure also has to be adjusted to what it would have been under the average stock amount. And indeed, your comparatives have to be changed as well. You should know that a change in depreciation rate is not a change of accounting policy. It is a change of accounting estimate, and they are called prospective changes. So the change of inventory is a retrospective change. The change of depreciation is a prospective change. You simply say, well, here's the valuation at the end of the year, and you depreciate it from that point onward over its remaining useful life. The second set of examples we have here is really dealing primarily with business risk. Well, that's what I want to bring out anyway. And we're thinking, what is a business risk? And we're also thinking, and what might the knock-on effect be so far as audit risk is concerned? The risk of a material misstatement appearing in the financial statements, and particularly one which we don't pick up on. So first of all, a company's begun to sell goods on the internet. So this implies that they have a website, and the website is capable of doing some sort of sales transaction. And I suppose what we should be worried about is whether or not the sales transaction, the debit to credit, the movement of inventory and so on, is properly integrated with the web pages. So when somebody buys something on the web, and no doubt you probably add on some sort of shipping cost to it and maybe VAT and so on, are those, I suppose, three elements making up the sales? Are they properly calculated? Are they properly posted? Does the system get cash from the credit card and so on? And if any of these didn't work on this new system, of course, then we are going to be getting erroneous entries into the books of account. Any other problems from selling goods on the internet? Well, we hope they get the cash up front. We hope there's no extra receivables involved within that. We maybe just think a little bit that quite often when you, if certainly you buy goods on the internet, if you buy goods for, say, some Amazon, there's nearly always a right to send those goods back. It depends a little bit on what the goods are. If they're technical goods like a computer or a phone or something of that type, it's probably not going to be sent back because you know what you're getting. But if you're selling clothing on the internet, and then people try it on, they don't like it, there is a huge amount of returns coming back. And I think there's going to be perhaps a kind of financial statement risk, audit risk here, in maybe making sure that when the goods come back, they're inspected. What are we going to do with the goods if they're in some way damaged? How are we going to maybe get compensation for that? At the end of the year, there are no doubt some goods that have just been sent out which are going to be sent back eventually. There's going to be a kind of post-period end, maybe adjustment that needs to be done on that. We should also perhaps worry about security problems of the internet. There have been many situations where there's been leaking of credit card details and the like. And if that happens and people's bank accounts and credit cards get charged improperly by other fraudsters, what's our liability as a company? Is there any evidence that any of this illegal activity has hurt any of our customers? A company started to export goods. Main problems here is what happens to goods in transit. Could they get damaged? If we're exporting goods, we're presumably getting foreign currency coming in. So it raises kind of how do you treat foreign currency in the financial statements. There is perhaps a risk of bad debts because we in general don't know the foreign companies as well. It may be more difficult to get proper references and so on from people. Maybe they feel that they are safe not to pay because they're way outside your jurisdiction and you won't bother pursuing them in a foreign jurisdiction and so on. Finance director has recently left and at period end has not been replaced. And I think I mentioned this on the previous chapter. Basically, we now have a ship without a captain. The accounts department used to be essentially overseen by the finance director, and anyway, we want to know who's now in charge of it. If it's a good accountant in charge, is maybe nothing to worry about here. But at least we have lost maybe this conduit to the board. The finance director is not any longer sitting on the board. What sort of communication is going on there? What sort of supervision is going on at the accounting department? And if it's year end, and we're having to make difficult, maybe judgmental calls on maybe the value of inventory, the value of contracts, the recoverability of debts and so on, and the most skilled person in the finance department is not there anymore, there could be some difficulties. Company has failed to file its tax return. Obvious difficulty there is, well, have we set up the liability for tax in the financial statements? If it's failed to file its tax return, are there going to be any penalties for that? Is it a deliberate failing of complying with the tax law, in which case we're going to begin, I think, worrying about the integrity of management, or is it just a kind of oversight? Maybe if there's anything to do with the previous example, it's because the finance director left and nobody knew they had to file a tax return. But again, is it evidence maybe that the ethics of the company isn't great, their internal control isn't great, and the like. We have to see maybe how good they are at complying with other statutory requirements, or whether they're a bit careless with those as well. An employee was badly injured carrying out his duties. And what we should obviously be worried about here, apart from emotionally worried about how this employee is, but as auditors, we should be thinking about potential liabilities. When people get badly injured, there's normally government inspectors come in and do some sort of inquiry as to why it happened. Are we going to be fined because we didn't follow the right rules? Is the employee going to sue us? If so, have we got insurance? Have we got insurance that will wholly or partially reimburse us for any damages that are due to this employee? Did the accident happen because, again, management wasn't very careful? Shows a careless, slipshod attitude. And has that gone elsewhere within the company, maybe in elements of internal control or sticking with other laws and so on? And we would need to go and, one of the things we need to do is kind of look at the accident book, where all accidents should be recorded. We'll be looking at correspondence with solicitors and the government department responsible. We'll be looking at the board minutes to see how the board reacted to this serious event. Computer virus disrupted the IT system. That was for 2 days. All seems fine now. Well, is it fine now? What was the nature of the disruption? Did it wipe all the records and they had to be kind of reconstituted? Did it put through some sort of fake transactions of some sort? Did it cause any damages to our customers or our suppliers? If it held details of inventory and they were wiped or destroyed in some way, it's all very well saying all seems fine now, but I would like some proof that all actually is fine now. How did they recover from this disruption? And also, what measures have they put in place to give us some assurance that it's not going to happen in the future? The company changed over its IT system to a new one partway through the year. It all seemed to go smoothly. But I think, as I mentioned in the previous lecture, this almost gives you 3 audits to do. There's auditing what happened under the old system and making sure that was going correct. There is auditing the changeover, because the whole set of transactions and receivables and payables, all those invoices and so on, all the inventory records had to be transferred onto the new system correctly, and that there's legions of ways in which errors can be made at that point. So how did this whole what's called file conversion stage happen? Did they have control accounts and so on to make sure that everything was transferred correctly? And then we have, for a couple of weeks, couple of months, we have our staff learning how to work the new system, and almost certainly errors have been made there. Hopefully they were corrected, but nevertheless, there could be errors made, and we don't know about them, and they could be still lurking in the financial statements. So we need to audit if you like, the last half of the year, maybe particularly the first couple of months of the new system, to give ourselves confidence that things are going smoothly. On our website you'll find a lecture entitled Jolie. This is based on the December 2010 question 1. It's a very good question for you to look at and to practice on. You can download it first and then watch the lecture. But it asks you to prepare briefing notes to be used in at a planning meeting with your audit team, in which you evaluate the business risks facing Jolie to be considered when planning the final audit. Using the information provided, identify and explain 5 financial statement risks. And then finally, it asks you to talk about the principal audit procedures to be performed in respect of one particular aspect of the audit. It's well worth doing.